Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Very well, Andrew. How are you?
I'm good. Thank you. Let's dive right in. And just to timestamp this, because of the events that's happening in Russia, or the amount of information we know. So this is Saturday, UK afternoon, California morning. And obviously we don't know what how this is going to play out, and obviously what the market impacts are. But this is stuff that we're discussing with our experts and trying to understand, and we'll be passing on those insights to our clients. As pertaining our discussion, let's focus first, I guess, on the U.S. situation, I guess in general, the developed market situation, and the data came out, the data that came out, any kind of central bank speeches, government speeches, and market reactions over the past week. So, yeah, what were your big takeaways?
I was surprised by Powell's testimony to Congress, not so much by what Powell said, which was basically repeating what he communicated during the FOMC meeting, but the questions from lawmakers. There were almost no questions about inflation. Also, most of the questions were about the increase in capital requirement for medium to large-sized banks. And of course, the Republicans being Republicans, they cried murder and, to various degrees, but there was almost no mention of inflation. And yet, if you look at the polls of the public, of the general public, they seem, inflation is a concern. So what I'm taking from this is that Republicans are more worried about banks being asked to pony up, and investors being asked to pony up more capital than by the impact of inflation on their constituents, which in turn means that Americans must be doing okay economically despite inflation, possibly because real wages are rising, employment is growing very strongly, there's still, a shortage of workers wherever you look in the US. Certainly whenever I walk around Los Angeles, I see signs, of vacancies, workers, opening for workers, and so on and so forth. So I thought that was kind of interesting because, as you know, break-evens have barely moved. The Fed has been systematically missing its inflation target and raising its expectation of inflation, which means that the tolerance of the Fed for inflation has been increasing. Now their forecast for end-of-year inflation is almost twice as high as the targets. And so what does it mean? What does it imply for BE? I think this generalized tolerance for inflation that's not hurting anyone yet is probably a big factor in explaining why BEs have not moved. And why people seem to have such strong faith in the Fed, which I don't share, frankly. So that I thought that was the most interesting takeaway from the testimony, the lack of focus on inflation. And another reason for the lack of focus could also be that inflation has been fairly stable.
Right.
So in my view, the markets are a little too nervous because all the Fed is planning to do is 2 more 25 basis point hikes, which, think of it, if you have a favorite corporate, in terms of investment, what will 50 basis points higher, a 50 basis point increase in the Fed funds rate do to their stock price prospect? Probably very little. No, I would argue.
Right.
So I think there is too much nervousness in the short term and too much faith in the Fed in the long term. in terms of data, what was interesting was
sorry, can I
yeah,
ask a question
please.
on that for a second?
Sure.
Two questions. One, so if I understand, your general view is the lawmakers, even just the general public, inflation is stable, okay, at a higher, significantly higher rate than the 2%. But if it's stable and real wages are rising or holding at a level even higher than that, then the kind of discontent is probably going down. So
Exactly.
if inflation is at 4.25 and wages are growing at 5%, most people are okay with that.
Exactly. I think for that to change, we either need inflation to start moving higher, or real wages, real income, real household income to start moving lower. But we are not there yet.
Okay.
So in terms of data, last week, there were a series of positive surprises in all the data around the residential real estate market, which just shows that it's recovering. And I mean, one of the sort of perverse effects of the hike and the increase in mortgage rates is that people are not selling their homes. So the sales of existing home are not recovering, which means that all of the supply on the market is actually coming from new homes. So actually, this increase in mortgage rate combined with the fact that people have borrowed for 30 years at fixed rate means that residential investment, which is basically new homes, is recovering faster than otherwise. I mean, new home sales are really perking up. And that's because that's where all the new supply is coming. So I bet you that when this quarter GDP is out, we're going to see a recovery, a positive growth in residential real estate from a contraction of about 7% in Q1 and 30% in Q4. This will be the fastest recovery on record. And it just shows that Fed tightening is not working.
It's just not, yeah. Okay, let me ask you, the question I remember that I was going to ask you is, do you think, as you were saying, that in the short term, the market's probably too negative, and the long term, the market's too positive, or has too much of a positive view or belief in the Fed? Why is the curve continuing to invert so much then? Because when is the point when markets start losing faith and you see 10-year yields at 4.5%? It is part of it. Do you think part of it is just because YCC in Japan, and that's basically part of continuing to pull everything down? Or do you think bond people are still convinced that fairly deep recessions around the corner, certainly within the next 1 year, and that's going to hit long-term yields?
So the YCC in Japan, it's been around forever. Eventually, like everything, it will end, but not just yet.
Right.
I think it's more the fear of recession, and so I want to address those fears actually, and in fact, I've asked our clients to come up with their best argument in favor of recession. I just think that as we move in time and it becomes clear that there is no recession, that's probably when the market will start to panic, or when there is real political discontent about inflation. But I think the panic is quite a while away, because we are stuck in a stable range with inflation, and it looks like other prices are adjusting to reflect current inflation. So we are in effect back in Goldilocks, and it could be for, definitely over the summer. I mean, you were talking about events in Russia and Ukraine. I mean, these are perhaps more important for EMs than for the US. Frankly, as long as we don't have an open conflict between NATO and Russia, I'm not sure how much of an impact the situation in Ukraine is going to have on the US. I mean, the impact, yeah. Unless we have a tightening of sanctions and some further impacts.
Somehow hitting oil or something, the price of oil.
Yeah, exactly.
Okay, and then the general market reactions to this data and speeches, and are you surprised by anything last week?
No, I mean, I just thought that the fear of the 2 more hikes is exaggerated. I don't see it as fundamentally changing the macro picture. And I think really investors are split into camps, those who believe that the recession is coming, so that's, the inverted curve, and those who see, growth, inflation continuing. And we need a string of data to decisively support one or the other camp. And because of the decline in energy prices, we're getting ambiguous data. We're getting strong growth data with okay price data or not getting worse price data.
Yeah.
And so there is something for everyone in there, and that could continue for a while, really.
Right. Okay. No, you've been consistent last kind of few months that it should be an okay environment for risk, barring some other exogenous event happening. So, okay, cool. And then for the week ahead, what should clients be thinking about, concerned about, and obviously barring that the situation in Russia doesn't overwhelm everything else?
So I think the events that could, I'm not sure whether it will be market moving because it's so expected, but the big event of the week is going to be the Supreme Court striking down the debt forgiveness plan. They have to do it by the end of next week. They promised they would. So usually they tend to stick to their promises. And it's such an obvious example of the administration basically not observing the power of the purse or the power of Congress in deciding on government expenditures. I think it's very likely to be struck down.
Right.
And actually, it's going to be less of an event than people think in macro terms, because first of all, the impact on the economy of the forgiveness was going to come over time when people had less to repay in terms of student loans, right? But the administration has not advertised it too much, but at the beginning of the year, they mentioned that they were working on repayment plans that would actually halve, perhaps even cut more for many borrowers, the actual debt service. So even if the administration is not able to forgive the stock, the principal, it will implement payment plans that will make it much less painful, new payment plans that will make it much less painful to pay. The forgiveness is the striking down of the forgiveness is going to have an impact on the budget, about 1.5% of GDP, improvement in the balance, but it will not impact debt issuance. Why? Because of the accounting rule of the US government. So when the last fiscal year, when the forgiveness was implemented, those fiscal rule mandates that the present value of the forgiveness is counted as expenditure. But obviously you don't, the actual cash flow impact for the government is when there is less repayment. So it's over time. And so when the measure will be struck down, the deficit will improve by the equivalent amount that was added to expenditures last fiscal year. But the impact, there will be no immediate impact on the debt issuance. So in other words, this is likely to get a lot of ink, front page news, but in terms of a macro impact, it's negative, of course, but perhaps not as negative as the news media is going to tell us. Other than that, we have the usual end of month data. So the most important, obviously, is the PC. And again, I'm looking for stability in each of Powell's three categories: core goods, housing, services without housing, stability in the median price PC. So not much of a surprise there. We also get the personal income and spending. There again, I agree with the consensus. I am looking in terms of my bullish view on growth and inflation. I am looking for a limited increase in the household savings rate that is still well below pre-pandemic level and has supported growth. I am looking for a continued further acceleration in the growth in real household income, excluding transfers, because historically this is actually a really good indicator of economic momentum. And I'm looking for continued strong consumption of consumer durables, because these tend to be linked to household expectation of future income. Other than that, we'll have quite a bit of data on the real estate. And there again, I'm expecting data showing a continued recovery. So we have home prices. I think they will continue to be positive month on month. We have new home sales. I'm expecting quite possibly a surprise here. Pending home sales, it's less important. Then we have manufacturing surveys, the Dallas Fed, the Richmond Fed, and the MNI Chicago manufacturing survey. I agree with the consensus. Manufacturing is not going anywhere, but who cares? It's only 10% of GDP. And if you look at the past couple of years, it's really in services that the recovery has been. We also get the durable good orders, not doing great, but durable goods orders are tracking mainly equipment capex, which is not very strong at the moment. But what is really strong and giving me confidence in the recovery has been software investment, amazing, and capacity investment, non-residential construction has really perked up. So that durable goods order is not going to be very strong, but again, like the manufacturing, it doesn't matter because it's such a small part of the economy. We also have the conference board consumer confidence. Unfortunately, all this survey data has decoupled with hard data. In that release, I look mainly at the indicator of job plentiful minus hard to find, which I think is likely to go down, but not by much. We'll have the third quarter GDP. This is stale information, but it's still, the third estimate of the first quarter GDP. This is stale information, but it gives us a baseline. And in that data, I am especially focused on consumption, capex, and residential investment. And finally, we'll get jobless claims. So there is a little bit of a cycle going on there with initial claims, which if you look at the pre-pandemic data, is typical of the claims data. This cycle where, initial claims go up and fall. It's just very noisy data because it's based on, on states data provided by the unemployment agencies, and those are in need of a good administrative uplift or good, someone needs to go in there and improve the efficiency. So noisy data, not worried about it. So that's about it.
Okay, so that's actually a decent amount of data. But you kind of outlined the ones that you think are most important. And obviously, I guess towards the end of last week, there was kind of some questions around growth scares a little bit. But obviously we see those every few weeks that but maybe it was more like you said, the market was reacting incorrectly, but the especially equity markets were a bit concerned about the Fed being a bit more aggressive than at least what was perceived a few weeks ago. Okay, and then yeah, I guess you kind of covered most of it. You know, you continue to see growth pretty strong for all the reasons you outlined. Inflation stable but not coming down, especially core. And so kind of the current environment, you don't see it massively changing. Again, barring any kind of big uncorrelated kind of exogenous geopolitical issue. Darling. So as we always like to do, I'll just go through a few things, certainly things I really liked from the past week that we released. So for Pro, the Bilal's, I don't know where he got 17, but 17 charts showing the market's mispricing is in his macroscope is super interesting, which I think all our Pro clients should definitely check that out. Henry Mustafa's Global Rates Weekly, going through their favorite trades across US and Europe, but specifically kind of breaking down the impact and the best way to play following up from this 50 basis point hike from Bank of England, which I know you probably would support the Fed doing that.
No chance.
Yeah, it doesn't seem like it's a good thing. Exactly. And then for Macro Hive Wealth, we released our asset allocation, which was a very interesting piece looking at the divergence between growth and inflation correlations.
That's actually one of my favorite topics, and I would use it as evidence that the market thinks that inflation is not an issue. I mean, basically the growth inflation correlation have turned, the bond stock correlation has turned negative, sorry. And that typically happens when shocks are mainly growth shocks because bonds and stock have a different relation to growth. So it's positive for stocks, negative for bonds. Right. And so when that correlation is negative, typically it's because investors see or think that macro shocks are growth rather than inflation. And it's when market shocks or macroeconomic shocks are inflation, that mainly inflation rather than growth, that the correlation between bond and stocks turns negative because inflation is negative for both bonds and stocks. And so the asset allocation has a in-depth discussion of this topic, which I thought was super, super interesting. So I thought I'm hoping that our readers will get to it.
Yeah, I think this whole table looking at the different, let's say, dimensions and what's the impact on stocks and bonds and the correlation is super interesting. And exactly to your point, this is how we ended up at this whole thing. You know, we thought it was transitory, or I guess initially we didn't think there would be an inflation impact. It was a short-term potential growth impact, and all this massive stimulus came out trying to address a problem and liquidity, potentially in equities and bonds, which was now looking back probably wrong. Yeah, so that's super interesting. And also for anyone, I think we mentioned in the past, anyone who's not involved in the beta rollout of Macro Hive Wealth and is interested in and is a family office, private wealth, even ultra high net worth potential client, please kind of email me or Andrew, Simon, macrohive.com, or obviously even info@macrohive.com, and we can get you added. We're also going to have a questionnaire going out this week, really trying to best understand how to tailor the product in the most useful way for our clients. So please look out for that. And we really appreciate any feedback and you filling that out. And that's kind of it from my side.
Cool.
Okay. Okay. Good luck, everyone. Good luck, everyone. Thanks.
Bye.